Happy Monday and welcome to Trading with Technical Indicators. My name is James Boyd. We welcome you here today. We have GH with us, Grace H. We welcome her. We have Jerry. Hello, Jerry. Greg, probability trader. Let's just call him JC, Jerry Camacho, and Melissa, Silas, David, and many others. Welcome to all Ocean Life. Welcome. Now, this is a weekly class we do every Monday at 1 p.m. Eastern. This is being recorded, and I'll share with you the playlist in just a moment. Let's go ahead and get started. So our focus here is talking about how do we use like indicators, whether it could be price, whether it could be volume, whether it could be an oscillator, all of the above, okay? Now, of course, when we talk about technical indicators, we'll talk about trend, support and resistance, and momentum as well. Now, just real quick as we get started, I want to give us some quick reminders that our examples will be stocks and options based. The information we talk about here is provided for general informational purposes only. And also remember when we bring up options, occasionally, we'll also want to remember that options carry a high level of risk and are not suitable for all investors. Also remember that Schwab does not recommend the use of technical analysis as a sole means of research. Now that's kind of empowering because, God, there's some other research that's very interesting as well, okay? And you don't want to just maybe only be looking at technical analysis. I think of that as like one side of the ball. There's other sides that you can't see with technical analysis. And so some of that analysis, we talked about fundamental analysis. We talked about intermarket analysis last Tuesday. Very interesting stuff, okay? At first, I knew the most about technical analysis. Now I actually feel like that's, of all the research that I look at, that's probably what I know the least about. Anyway. Now, remember that investing involves risk, including loss of principal. Now, today I want to talk about the indexes first off, sectors, of course. I want to kind of talk about some of the big things we're seeing on a bigger basis. Let's call it intermarket analysis, because that's really what it is. We'll talk about how some of the equities are kind of changing some of the things we're seeing in the US dollar and also in the commodity space as well. Big moves here overnight this morning as well. So we'll bring that up. Second, we're going to talk about some examples in the current markets. We're going to talk about continuation, and we're going to also talk about some price patterns as well. So let's go ahead here and just kind of take a look at, now before I even go there, what have you been looking at? Confess, okay? What things have caught your eye this morning that you said, James, maybe I've been looking at this. What have you been looking at? Well, so remember, we like to, when we wake up in the morning, okay, we all do, that's why we're here. The biggest actually thing is we're looking at the prices, okay, of what's going out there. Prices could be gold, it could be silver, it could be oil. And that could sometimes translate to, let's say, the equity markets and then individual stocks and so on, okay? Now, the first thing that we actually notice is if I brought up, let's say, the XAU, if we kind of use this as an example, and we talked about this on Thursday, Friday a lot. We talked about gold miners that were outperforming gold prices. This is a pretty big pop here today. Now, this is your classic example of what we talk about, the three candle pattern. So when we talk about that three candle pattern, what I mean by that is when we have a down day, okay, red candle, and then you have an up day. The up day is not Cahold, but it's a green candle, okay? And we just call that day CH. What does CH stand for? It stands for close higher, and the investor is looking to see if in the next morning, if there's a gap, okay? And I'm going to label that as G for gap. So this is your classic example of where there was more of a diagonal line, okay? Diagonal line. We saw the price actually break out, and that is your classic CHG pattern. Now, if I showed you Cahold, close above the high of the low day, that's close above the high of the low day that I just circled, okay? That's a way to get an entry set up. Not the only way. But if I look at this is a three candle pattern, and that is your classic down day, close higher, gap. Now, I need you to say that back to me, okay? Now, I can hear you. I'm joking. Say this. Down day, close higher, gap. Down day, close higher, gap. Down day, close higher, gap. I'm going to tell you, I think a lot of people kind of miss that. They're so used to this one, Cahold, but they kind of forget that down day, close higher, gap. Now, again, if you looked at the prices of some of the products out there, whether it's gold, silver, and so on, we would just naturally be thinking, well, well, how would I have known that perhaps? Well, if you looked at the prices of things out there, you would have seen the gap or that it was up pretty high, even posted on X as an example. And what you're now going to notice is then you're going to look at some individual stocks and some of them might be getting the move. Now, this is not just gold. It is also silver, high-ho silver as well. Now, the gold miners were leading last week on Friday, and what you're going to notice is gold prices also went with that as well today. So they're kind of more trading in line with each other. The big difference we would actually say between Friday and today was silver really got engaged, and we're seeing not just gold miners involved, but we're now seeing silver miners as well. Now remember, when we actually have equity markets and there's maybe a little confusion in equity markets, it can actually cause investors to actually go to cash. Now, cash does not necessarily mean they're sitting in cash. They could be sitting in money markets. They could be sitting in T-bills. They could be sitting in many other products that actually just have a return for a duration of time. They could also be getting into commodities. Guys and gals, this is classic. If investors, for example, are getting out of some equities, it doesn't mean they're actually getting out of everything. They're going to search for things that are getting a potential return. We cannot say there's not trends out there as these stocks or these prices hit brand stinking new highs. Ooh, okay, now, any questions with that? Okay. Now, the one thing is we're going to look at some examples in there in just a moment, but I think that's probably the chart of the day that started up and it just kind of kept going so far. Now, the one thing we also want to kind of point out is tariffs on steel. If you import steel, 50% tariff. So we did actually see some of these steel dynamic stocks, things like that. They got a pretty good push. Now I'm going to use STLD for a proxy of silver. You might use something else. I know how you feel, but I can't bring that up. If I brought up X, you're going to see that X has actually gone up United States steel, as there's been discussion upon this import tariffs, etc. Some of those steels also engage as well. Copper has actually done fairly well, but it's really been gold and silver mostly. Okay. Now, when we talk about the SPX, now I'm going to come back to gold and silver in just a sec, but I want to kind of look at this. When we talk about equities, what you're going to notice is if we were going to say what type of price pattern are we seeing in the general market? I'm not talking about just indexes. We're bringing up sectors, industry groups, and stocks. If we said many things look like what type of price pattern? The answer is so many things kind of look like a pennant pattern, higher lows, lower highs, squeezing. And when these lines start to kind of overlay on top of each other, you could actually, for example, get a potential breakout one way or the other. Now, the idea is if it was uptrending before we got into this pattern, the idea is, could it go higher? That doesn't always mean it does. It could even actually start to break down. Now, the one thing to kind of watch is, if we go up like this much, okay, and sellers are not able to push it down, maybe people that are truly taking bearish positions. Now remember, if they're doing it in the form of derivatives, every day that goes by and it doesn't really go down, they have that time decay that's eroding the value of the options. If they're shorting the shares, every day that goes by, to some degree, they have what's called short interest, okay, or margin interest. So, going bearish, if it doesn't go down, it can be a costly type of trade, okay? Now, you might say, I don't completely understand that. Just know that going bearish is not as easy as it sounds, okay, if you will, to go up over time. And there's inflation reasons for that. It's also kind of the investor base. It's also survivorship bias. Some of the companies that drop out of the indexes and the sectors are no longer there, and they're replaced by the companies that are winning. So there's lots of reasons why kind of over time the indexes tend to go up, okay? Now, the one thing is, if we take a look at this, okay, and by the way, if you have a question, Cameron May is in the chat, so just know that as you see in the initial CM is with us. Cameron May, welcome him. Now, so many investors might be thinking, James, our 100% line that we've had for weeks has really been 57.81. We're still there. Matter of fact, when we came down there, someone came in to buy right at that level and then pushed it back up. Now, I know how you feel about price patterns, James, how do you know how I feel about price patterns? Well, most people say I like price patterns when they're done. Okay, I like price patterns. And by the way, what are price patterns? They're support resistance lines that are at different angles. I like price patterns when they're done, meaning the price breaks above or breaks below. Okay, I think we know how each other feel now. Okay, now when you look at the NDX, okay, before we look at just some individual stocks, you're going to notice that the line that we actually had there, which the NASDAQ never got down to 20,297, never did, got down to the bottom of the channel, which I'll widen this out so we can see that. So we'd have to still say that the NASDAQ still has some pretty good mojo, considering that it went up a lot off the bottom, to say the least. And it wouldn't take a whole lot for us to go back up to the top. I mean, just to go back up to the top and hit 52 weeks high, if we did that, it would only be a 3.44% move to get back to the 52-week high. Now, if you're a bear, that just is humiliating, okay? Because you thought if you had a chance, this was it. And all of a sudden, it's like, my gosh, I mean, wow, okay? Now, this is where kind of news is told, and maybe sometimes news is not as bad as feared. And that's how news sometimes is, okay? And maybe it's changed. And sometimes people also want to try to get in. And you also got to remember that sometimes investors' duration is not the next 2-3 days. They might be trying to buy for the next 5 to 10 years, okay? Be careful on being so short term, you miss the point. Now, what I want to do is I want to take a quick look at sectors, and I just want to kind of just, before we look at some individual examples and talk about some indicators. When you look at utilities, the one thing is we always, as investors, we just always want high flyers, okay? We want to make as much money as possible. That's the investor's mentality, right? Well, you got to remember something. And I'm just saying that's how a lot of investors, they think sometimes. But you got to remember that not all investors are trying to get something that goes up 100%. Sometimes investors want something to hold price level and then grab some yield, okay? Now, if it were to go up, it might go up, but it might not go up like growth type areas, right? So utilities is actually still holding in there quite strong. And I know many of us, as we're getting closer and closer to retirement, some investors kind of like some things that kind of have more stickability to them. They vary, but they also might have some income potential. They're still holding in there. When you look at Staples kind of slowly nudging its way up. When you look at, let's say, also the real estate, $IXRE, it's amazing it's held in as much as it has, considering the rates have been as high as they have been. They're still holding in there for the majority. So some of these sectors, and we know that we're going to keep an eye on basic materials. Why basic materials? Well, we're going to watch basic materials because we just talked about steel. We also just mentioned gold, and we mentioned silver, etc. Could actually commodities, which is going to come through typically, the base materials and or energy. The one negative thing about energy and oil in general is OPEC has continued to say, hey, we're just going to pump more and more and more. And so oil, as we talked about with Kevin, is very tough right now because every time you get weakening data, OPEC just says we're going to pump more. And so they're oversupplying and pushing the price down. Could energy still underperform? And maybe could investors be looking for basic materials? That's the idea. Let's look and see, could basic materials get a push? Now, I want to kind of speak to just real quick. Let's go back to the gold stocks for just a moment, okay? Now, what I want to do is I'm going to go to just real quick scan, okay? And if I looked at scan, what I'm going to do is when I scan, I'm not really scanning for any certain filters. I'm really scanning for just a watch list and volume, okay? Now, if I took a look at this, I'm going to swing back to an example, a question that was asked from last week, okay? So stock price, 40 bucks, 500,000. I'm going to say, look, scan in steel, nah. I want to actually go to just by industry, and I want to go to materials, and we're going to go look in, let's say, metals and mining. Now, notice this is like as basic as it gets in terms of like criteria, okay? Now, always remember with this is If I say 500,000, this is not saying average volume. This is saying volume now or higher. Now, if I did select all materials, okay, say scan that, you're now going to see there's 27 stocks. Many of us don't even use this right here, search results. What we do with this, the list itself, is we actually go to this, click on the little 3 lines right there. We go save it to a watch list. And this is how we're raking out some of the things we want. This bottom piece right there is just really the search results that we're going to make into a watch list and that we're going to look at. Let me show you what I mean by that. Save as a watch list. And so once I say save as a watch list, I'm just going to label this as 1-1 watch list. Okay, now here we go. Save. We're going to go right back to watch list right there. Go to quotes. Now, the first thing is what some investors do is they say, James, I'm going to just list this from the highest price stock down to the lowest price stock. Now, why does someone do that? Well, typically, if they're doing that because they want something that might have a higher market cap, okay? Bigger companies, okay? Now, you're going to see at the top, SHW, Sherwin-Williams, FNV, I'm not sure about that. There's Steel Dynamics, there's AEM, there's NUE, and so on, okay? Now, could we have stripped this down to just gold and silver? Sure. But if we take a look at this, what you're now going to notice is the 2 biggest ones in gold and silver, those are the ones that are up. NUE is up 8.5%, okay? AEM is up 5%. And if you're going to look in the past, like say 3 weeks or about the last 2 to 3 weeks, those have really been the ones that have actually been stronger over the last 2 to 3 weeks. They have been in trend 3, okay? And if we said which one is really showing a call hold, and or a stock hitting a brand new high, it is really AEM, and we can also see that right there. Now here's what's kind of funny, okay? This screen that you're actually looking at, if it is upward trending, showing relative strength, bouncing up, breaking out, any of the above, this screen is going to show it, okay? It's going to show it, okay? Period. It's just going to show it. Now, here's the thing. If you find a stock that was, let's say, at 52-week lows, and then today it was announcing a merger or acquisition, it's bought out, et cetera, that's not what we're talking about. We're talking about something that has a trend that is bouncing to the upside, crossing over. These scripts, which are not guaranteed for accuracy or timing, they're really designed to find those setups, okay? So I would say many other things that are outside of the screen are derivatives of these, okay? Now, if I actually go back to this, what I want to do for just a moment is let's pull up AEM for just a sec. And if I pulled up AEM, this is what we have. I want to kind of show us this. Now, when we talk about breakouts, we know that breakouts are not just horizontal, they can be diagonal in nature. Some technicians, they like diagonal breakouts better than horizontal because it could be a swing back to the prior high. So if it broke out of the diagonal line there, it could go use that prior high as a potential target, okay? Now, if I go forward, what you're now going to notice is brand new hold after that. So if the investor missed this day, 2 days later, doink, a brand new hold. Notice on day 2, classic red candle. We go forward again, down day. Hold does not guarantee it's going to go up that day or the next day. It's just a setup. We go forward and walk through what happens. There's your down day, close higher. And what are you thinking now? Could it get a gap? That's what you're thinking. Down day, red candle. Close higher day, could it get a gap? Do we have it? There it is, okay? Now, I want to kind of go back to this for just a second, okay? Now, we know that if the investor decides to say, look, I'm going to choose to take a strategy, some strategies, as we talked about over time, we know that if the investor buys a stock position, it's the most bullish thing you could do, okay? If we buy 1 share of stock, it has 1 delta. If I buy 100 shares of stock, it has 100 delta. The delta is the sensitivity to change in the stock price, gain or loss, okay? And it's also going to be the most capital intensive, okay? Now, here's the deal. If we took a look at this and said, well, James, we know if we buy the stock, someone's really thinking that there's a very high likelihood that the stock could actually go to the upside, okay? Or they just don't want to do options in general. Now, what we could do is say, look, can I go down a little bit to the left and say, could we do a cash secured put? That cash secured put, the problem with that is there's a cap, okay? Boo. There's a cap dollar amount known as the premium. But if the investor does that, they're really saying, look, I think this stock, the investor says, could stay above 115, 116, and so on. That's really what's happening. Now, the problem with actually the cash secured put is if the stock goes down or it doesn't go down, you could be assigned to buy the shares from now until expiration, not just at expiration. You have to understand something. There's three main types of options. American options could be assigned at any time. European options, only on a set expiration date. Bermudan style options, they can be assigned on different periods. We don't even get into those. But there's three main styles: American, European, and Bermudan. Okay? The main style that we're used to is American, as we're in America, and some people like European options, but we don't talk about those that much. But they are there. So the risk of doing American style options is you have to have the foresight, the mental, I get that I might have to buy the shares ahead of time, regardless of its expiration. It doesn't matter what the price is. Now, someone said to me last week, why do you yell when you're making some of your points? The same person that says that then tells me no one ever told me. So if I get ever loud, just know he's saying that so it gets knocked, as my dad would say, James, I'm just elevating my voice so it sinks into your brain. So that's why I do that. So please don't ask me. No one ever told me that. I'm trying to elevate my voice to make sure you get the key points, okay? And if you ask me that question, and I know who it was, and you say that, I'll be like, there's a reason why I elevated my voice, to make sure you got it. So forget how loud I am sometimes. Why is he getting loud? Because I'm making a point, okay? I want you to remember it. And sometimes, here's the other point. As a coach, I don't want you to take 20 years to get it, okay? I would like to take 20 years down to 2 years. I want you to learn as fast as possible, okay? So that's why sometimes we want to make sure we get key points earlier than later. Now, what I want to do is I want to go back to this just real quick. We're going to go back to the trade tab. And what I'm going to do is I'm going to type in AEM, okay? And on this AEM, what I'm going to do is I'm going to go back to strikes. Let's go 6 or 8. Let's start with 6 first. Now, the one thing that we have different this week compared to last week is we have the June expiration, okay? We have the June expiration, and then we also have the July expiration. All right. So if I take a look at this, okay, we got 124, okay, got the strike 120, got the strike 115, got the strike 110. What's the advantage of going to the Julys versus the Junes? More time, maybe more premium. That might be a true statement if the implied volatility was the same, okay? So 35, 37. So what we would probably expect is if we went further out, the premium should be bigger, hence more time. Now, if I take a look at this, if the investor said, I'm going to sell the 120, what are they thinking? They're thinking the stock could stay above 120, and they're also thinking, I don't mind to buy those shares at the strike price from now to expiration. Now, secondary meaning for that delta, right? The delta is really showing a statistical probability. What is the chances of the stock to close 1 penny below the strike price? As of right now, 36% chance. Now, if you wanted higher probabilities, there's an offset. If you had higher probabilities and said, look, I'm going to sell the 110, there's lower premium. And that should make sense. I mean, you shouldn't be giving something for nothing, for a lesser chance, okay? So if there's a higher chance, higher premium. Now, if I click on the 120, now, what we're going to do is we're going to open this up to more strikes. Why are we going to do that? Because one of the negatives of doing cash secured puts, when we right click on that 120, we're going to go to sell and then vertical, okay? Now, by the way, I want to kind of say a comment. if the person says, why do you elevate your voice? Like, I'm not mad at the person. I'm just answering the question back. Why do I elevate my voice like that? It's because I want to make sure people really get it. Okay. And there's some times where if someone just speaks to you very monotone, that you don't understand key things of what they're saying, or you as a listener don't understand what are the key points, because you might not have that same level of experience. The key word is yet. Okay. So I'm not mad at the person. Okay. Good question. I saw it. I answered back. Now, if the investor says, you know what, James, I'm going to sell the 120. Okay. And what I'm going to do is I'm going to buy the put out of the money. Now, the only reason why the two main reasons, we want to just have a right to sell just in case. So when you look at this and you're selling the 120, that's really it's the obligation to buy at 120. And when you buy the put, it's the right to sell at 100. Now, do we think that's ever really going to become worth something? It could, but a very low chance. Think of this as a backstop. Think of this as a floor. It's a right to sell at 100, not a maybe, not a depends, okay? It's a right to sell, okay? Who controls the right? The buyer does, okay? What's the credit? 370. So notice what it does. The premium was, let's say, 410-ish, but since we're buying a put, we got to pay something for the put. That right ain't free, okay? And it pushes the credit down. And it will also increase just a little bit what the break even is, okay? So now what you're going to see is the 120, and you're now going to see the break even price, max profit, and the max loss. Now, the second point of buying a put out of the money on a cash secured put is if you're doing this in an IRA account, which will show that, try to, is it's not going to tie up as much capital, because the buying power effect is going to be what the max loss is in an IRA, okay, for a cash secured put with a downside protection. Now, this is a cash secured put with a bought put below, okay? You could think, I like to think of this as a short, wide put spread. Why do we say short, wide? Well, because in a short vertical, the strikes tend to be closer together, okay? So I call it short, wide vertical, which has more characteristics like a cash secured put, because the credit is higher, and so is the delta, and so is the theta, okay? And so is the vega as well, negative, okay? Now, there you go. Okay, so I just want to kind of walk through some of those details. Now, what I'm going to do is we're going to try to, so it's teed up trying to sell. Now, we do have some shares of AEM. Those shares, when were they purchased? They were purchased on the 29th. Now, I'm going to tell you, if I could go back to 1996 and say what was one of the stupidest things. Now, I could say stupid because it was me. It was foolish, okay? So one of the most foolish things I've ever done is a lot of times people think, well, if I got into that stock, I'm just going to go look for something else. That's maybe not a great idea, because that trend might still be trending. Okay. And so that's what we got to remember is a trend is going to tend to have many higher lows potentially in that trend over time. This is why some people that have experience tend to focus on some key stocks. Okay. And James, why did you say what you did was not very bright? Well, I didn't understand what trends were. Okay. I just didn't know. Forgive me. Okay. But it was foolish when I look back on it. Now you might say, well, James, you already have shares on AEM. You got to remember that's an individual position. True. And if we did a cash secured put, that is a different position and has a different break even and some also different dynamics as well. Okay. Now, what I want us to do is also kind of go back and take a look at another stock. Okay. One of the stocks I want to kind of point up that we brought up, speaking of kind of looking at trend again, is MA. Now, a lot of times investors, and I did this too, okay? Hey, I like moving average crossovers. And if we were to ask investors, show me the last time you did a crossover and you were kind of in the first 1, 2, 3 days, maybe the answer doesn't come back as quickly as we would want it to. Well, speaking of that, let's say the investor said, James, I actually kind of noticed a little crossover, a little moving average pinch, okay? Let's say the investor said, James, I'm going to try to buy maybe a little Boeing, doing a little bullish trade. And I appreciate you being so lift me up there. I kind of got down on myself a little bit, didn't I? Now, you got to remember, we didn't have webcasts back in 1996. I was on American Online. Shh, dial-up internet, making that little crackling noise. Yeah, we didn't have that at all, okay? Now, if we take a look at this, if we go back to, let's say, the 3-year weekly chart, this has been one that really got inside this old channel, okay, 195. And the biggest thing is the next potential level might be in the vicinity of 220. Okay, now I'm not even going to go above there. Okay, now when is the next earnings? Now the next earnings is July 30th. Now, could investors be buying now in anticipation of what those earnings are? Could they be selling now in anticipation? Well, of course. We always talk about the example of farming. I mean, the farmer plans in anticipation of what the corn price is going to be. You bought the house in anticipation of what the neighborhood was going to be and could be like in the future, and so on and so on, okay? Now, what I'm going to do is I'm going to go back to this, and now someone might say, well, it's a red candle. It's a red candle. Why? Well, because it's currently trading below the open price. All right, so that color of the candle has in reference where did it close or trading versus where did it open. And also it's actually green on the day because it's actually trading above where it was on Friday's close. Okay, now what would you like? Well, you like a green candle, okay, and have the stock up today. Understand. But as we're looking at this right now, it's just a little bit below that. Now, let's say the investor said, James, I don't do options. Okay, I don't do options. Okay, let's say the investor said, I just want to buy shares of Boeing, looking for the stock to maybe go to the upside a little bit. Well, if I look at Boeing, now, this is kind of a different viewpoint here. And what you're going to now notice is some investors, they try to get in when the color of the candles are green. The color of the candles are in reference to where the price is in relationship to the moving averages, namely the 10-day exponential and the 30-day simple. So if we get a purple color candle, we're below the 10 but above the 30. And then all of a sudden, if we have red color candles, we're below both moving averages. Now, the moving averages that are on this chart are the whole moving averages that are a little closer, but we could just put on the other moving averages, pretty simple. But the candles themselves, that's how they're showing. It's based on the exponential and the simple. Now, what you're going to now notice is when the color of the candle went green, for the most part, there was kind of more of some higher lows or a building of support. And there was a little move to the upside here. There's a little bit of move to the upside here, a little bit of move to the upside. Now, if someone said to me, well, James, I can't see flags to save my life, I would say, well, that was the problem, but not now. Because really, when you're looking at flags, whether they're sideways or pullbacks, so if we got more of like a run to the upside and then a sideways movement, we would really be seeing orange color candles. If we actually saw, for example, a run to the upside in price and then a little bit more of the pullback, we would see orange, O for orange, and purple color candles. And if we actually saw a run to the upside and a deeper pullback, we would really have orange, purple, boo, and then we would see red. So we can see that when you start pulling back, this kind of goes back to, is this really a flag or are there sellers smashing the stock down? Okay. Now, so the comment really came in from Creeker1. How do we scan for this pattern? That's the question. How do we scan for this pattern? How do we scan for it? Have we gone over that? Have we? Okay. So I'm going to throw that out there. How do you find it? Okay. Now, what I'm going to do is I'm going to right click on the price graph. Now, Creeker1, I'm not going to forget. I just want to kind of see if anyone can answer that question. We're going to go buy custom. We're going to go with OCO bracket. Okay. Now let's imagine in this example, we're going to try to put to work $6,500. Okay. Now some of you that live in the South and you're used to that $6,500. Okay. Now, I live in Kentucky, right north of Nashville, okay? And that's what we would say, $6,500, okay? Now, some of you are like, $6,500. Now, let's say the investor said, James, I'm going to look for that stock to go up to 220, okay? Now, does that mean the investor might not be able to put a higher price? I'm just saying one of them, okay? The lower the price target, the more cautious they're really being. Now, if we kind of looked at this, could the investor kind of maybe use the moving averages? Now, notice there's that change of voice again. Could they use the moving averages? Why did I just do that? Because I want you to think now, okay? Could the investor use the moving average as an area of support? Yeah, they could. Now, I'm going to kind of mark two levels. Uno, and then what you're going to notice is a little plank or plateau of support, really right there. Not a huge difference, but some difference. Now, if the investor said, James, I'm going to look for 205.96, less 2%, it's going to give us a stop, which is a trigger to sell at 201.84. Creeker one, I'm coming right back. Stay tuned. 201.84. Okay, I'm not going to have any more fun. I'm not going to have any more fun in the session. Okay, I've hit the fun limiter today. Now, what I'm going to do is once I know there's 30 shares, okay, I'm just going to take this to 30. Say, give me 30 shares, okay? There it is, okay? Target, stop, GTC. Okay, now, how do we find those? Well, if we went back to Creeker One's question, and we're going to go market watch quotes, and what I'm going to do is, once I go to market watch quotes and pull that up, so remember in our list, when we're looking at, let's say, the Dow Jones, etc., there's two main ways to really find what we just found, okay? So number one is we would be saying, James, I'm really going to be looking for a whole count moving average, that 10HC. That is really showing the color of the moving average, and then which clearly we want to be green, okay? And the second thing about that is we want that to really show maybe a number like 1, 2, 3. Now, does anybody know why? Does anybody know why we don't want it to be 35, 25, 15? Okay, because if you're waiting to 15, 20, 25, 30, 35, that actually just means where were you before that? Okay? Where have you been? Okay? Now, if I went to, let's say, Boeing, and I put a little X here so we can see this, Boeing is right here. Okay? 3 days right there. All right? Now, the one thing what you're going to notice is, so on the 20-day hold counter, same thing. Could we get something that's maybe 1, 2, 3 days? And what you're going to notice is on the 20-period moving average, there's one that is just 1 day, today, in other words. So that would be like one thing to look at, okay? Looking for stocks where they're fresh. In other words, if I looked at a stock that, let's say, that was showing example given like 15, man, the entry setup, if you're trying to buy on a moving average that just turned, PG is not one of them, okay? It's been up for 15 trading days. That means if someone was trying to buy on the actual entry setup, they're 15 days late. Now, I should say late equals they're 15 days since the first time the moving average turned green. So the goal of some technicians, so they can try to buy closer to support, is they're trying to get on the first 1, 2, 3 days where it's closer to support, meaning hasn't gone up as much. Now, the last answer to the question from Creeker One is the moving average crossover. There should be no reason why the investor can't see that. Why can't they see that? Which moving average has crossed over? Well, you got UNH crossed over today. You got Amazon that crossed over today. You got, Amazon crossed over today. I just want to check on my lines. Amazon crossed over, and so did actually Apple as well. All right. Does that answer your question? Okay. So those would be like the 3 columns that I'd be looking at. Now, some of you might say, well, could you share those? I post them all right on my X page, okay, because I want you to have those. And what you're now going to notice is if you go to this X page, right at the very top, just let me kind of point to where you could look. So right at the very top of my page, if you said, where could I see that 10HC, you're going to see the 10 whole label counter, 20-day whole label counter, okay? Now, if you said, James, I don't know what the difference is that for the market watch? That's for the market watch. If you said, James, I would like the label counter on the chart, so notice I elevated my voice for a reason, on the chart. So there it is right there. It's in red. Just got to read it now, okay? Anything that's red on the chart, on the chart, on the chart, on the chart. So the information's there, okay? But what happens if it's not it's not labeled as on the chart? Well, it's a script for the market watch columns, okay? So there's scripts for chart, there's scripts for a market watch, and so on, okay? And also just remember the scripts are not guaranteed for accuracy or timing. Now, want to also go back to something just real quick, and let's bring up a couple stocks that are kind of showing a little push here today. Now, the third example that I want to take a look at here today is Meta. Now, we got some of you that are technicians where you like to look at Fibonacci, okay? Now, and I love Fibonacci, okay? And I love the math behind it. That's what I really mean by that. If you've ever studied the math of it, it's pretty interesting. Now, if we took a look at this is where the move started recently in the last 2 months, and then it's ran to the upside. Now, calling all technicians, okay? I got a question for a technician here. Now, if we go up, if we started at 484 and we went up to 661 and we stayed above the first level of that Fibonacci, is that telling us potentially anything? Does that tell us anything about the current status of trend and momentum? Now, that doesn't mean it can't go down tomorrow, the next day after that, etc. Or Meta comes out and says, by the way, we're closing down the company. All of a sudden, news changed drastically. And by the way, that could happen at any time, okay? Now, if we take a look at that, after that big bombs away run to the upside, not much of a give back, okay? Now, what you're now going to notice is we saw kind of where we went down to that 23% retracement line just lately, and then just like we talked about, a little moving average crossover. Let me see. So if I went back to, let's say, a list, and if I said, hey, if I pulled up the NASDAQ list, maybe number 1 or 2, because we break them down in half, so that way the scripts can run, I'm just going to look for the M and say, is Meta on that list? Not on that one. Is Meta in that second list? Let's double check. Is Meta showing up on that list? So here's Meta. And what I want to do is Meta showing up on Creeker 1's question, which is, can we find it? Now, what you're now going to notice is I'm down here. There's your crossover. On the moving average, do we have something there where in the last 1 to 3 days where it's gone up? And the answer is, well, on the 20-period moving average, it's up 1 day. It's like fresh bread. I can almost smell it. It's not really. But if we take a look at that, you're going to see that the 20-period moving average, that's 4 days. Now, remember, we talked about 1, 2, 3, 4. 1, 2, 3, excuse me. This is 4. So it's been up a little bit more. But what you're now going to see is that 20-period, which is the lagging confirmation. Okay, it's 1 with the moving average crossover. Okay, we go back to the chart, and we'll do this quick. Let's say the investor said, you know, James, could that maybe go back to the upside? About ready to find out. Where is that prior upside? Well, that prior upside, it might be in the vicinity. Now, we don't know if it's going to go up there. 716, you got this level, 735, and I'm even going to be a little bit more negative, okay? Negative Nelly here, okay? Someone got to be negative, okay? There always has to be a Karen or a James or a Bob or a Todd. There always has to be someone that takes the opposite viewpoint, okay? Someone has to. Now, if we take a look at this, let's say the investor said, James, I think it could go to the upside, and I'm going to target really that 716. And I'm going to kind of put the middle of the rung there. Not the lowest, but maybe something there in the middle, okay? And then underneath, could maybe the investor try to set the stop underneath where the moving average is, really about 643, 22. Okay. Now, if I looked at this and said, where could that stop be if you use the moving average as support? Answer 630.35. Okay. Now I got to wrap it up here, but if we put that number right there, 630.35. So shouldn't be really a problem to actually find those, as we actually saw that as well. Now, what I want you to do is I want you to go out there and practice finding some stocks that are showing some moving average crossovers. Practice using that whole column and the moving average column to try to find some of those setups. You look at most examples out there, that's what we're seeing. That's what investors are biting on currently and trying to take some bullish positions. Now, remember, stay tuned for Cameron May coming up next. And let me check that. But also, I want to say thank you so much for your comments and your participation. And also, one thing I want to do is just remember that, let me just pull up this real quick. And let's go to this and pull this up. Okay. So if we pulled up, yeah, it was Cameron. Sorry, I was thinking, I know Cameron actually goes there too. So Cameron, you got me covered on both. Okay. Cameron May coming up next on Trading Comfort Calls and Short Puts. Thank you so much for your comments and your participation. Remember that all investing involves risk. And this has been the class on trading with technical indicators. Thanks so much. Take care. Bye-bye.